So, in this video, we're going to be talking about your run rate. In business, there is a concept known as revenue run rate, and it is a metric that is used to forecast a company's future cash flow. They basically calculate the revenue data that they have, and they use that to estimate the revenue for the year. So, in the equivalent of personal finance, this would be your annual income. Now, not everybody knows what their annual income is. They may just have their hourly rate. So if you know your what you're getting paid per hour, you can easily figure out what you're getting by year using the most simplest and easy calculation that I'm going to tell you now. If you're making $14 an hour, $20 an hour, simply multiply that number by 2. So in the case of 14, that would be 28. And then you simply add 3 zeros to that number. Voila, you end up with 28,000. So $20 an hour times 2, 40, add 3 zeros, $40,000 a year. And you can do this with basically almost any number. Now it's a quick estimate and it's based on 40 hours a week, so a full-time job. And this simple formula works the opposite direction as well. So if you're just curious on what you make an hour, and let's say you're earning $100,000 a year, you simply take off the 3 zeros and divide it by 2. So the 100,000 becomes 100 divided by 2 becomes $50 an hour. Now it's really important to understand what you make in the year. So in the case of someone earning $14 an hour or $28,000 a year, you're trying to get to what is your daily run rate. So you take that $28,000 and you break it down into a daily rate. And you simply do that by dividing it by 365 days in a year. And that would bring you to $76 a day. So a person earning $14 an hour earns $76 a day. But that's just the money they have coming in before taxes. That's not their net pay. That's the gross. And so you kind of have to do another calculation and determine taxes. So in this example, I'm going to use the $100,000 a year. Let's say someone is earning $100,000 a year and they are putting 10% in their retirement. That 100,000 now becomes 90,000 because 10% of it, or 10,000, is going in their 401k. That would put them probably in the marginal tax rate of 22%. So the 90,000 would be taxed 22% for federal tax. And that would be approximately 19,800 a year. And then on top of that, they would get, if let's say they live in New York, they would be charged with New York State taxes, New York City taxes, unless of course they live outside of the 5 boroughs, and they would also be charged the FICA taxes, which is the Federal Insurance Contribution Act, and this would be Social Security and Medicare. So, going through that, it would be New York State taxes 6.33%. New York City tax is 3.9%. FICA tax is Social Security tax, which is 6.2%. Your employer pays the other 6.2%. And then Medicare tax is 1.45%. So essentially, someone earning $100,000 a year who's putting 10% in their 401k would be left with $54,000 a year in net pay. So you want to take that net pay and divide it by 365 days. So let me just open up a calculator and do that. And that would give you approximately, we could even round it up, $147.94. Let's just be generous and say it's $150 a day. Then there's a quick, easy formula to figure out. So you're earning $150 a day, but you have expenses to run your life. So we know what your run rate is as far as cash flow coming in, right? It's $150 a day. To figure out what it is a month, you would multiply that by 30, or a simple way to do it is multiply it by 3. So 150 times 3 would be 450. And then you simply add 1 0 in the end. It's the same thing as calculating, multiplying it by 30, but it's just the quick way. So 150 times 3 is 450. Add a 0. That person is taking home 4,500 a month, approximately. So you can look at your expenses monthly and determine what they are monthly, but understanding that you only have $150 a day will hopefully stop you from overspending money. Now, if you're only earning $4,500 a month and your bills are $3,000 a month, that leaves you with $1,500. You could take off the 0 in the end, and that would bring you to 150 and divide it by 3, right? 3. And that would give you $50 a day, no more in spending, to come up with that number. So that's if all your bills are 3,000. That's a pretty good amount of leftover. So it's important to figure this stuff out, because when it comes to purchasing things that you see, if you know your daily run rate is 150, but your expenses daily run rate is 100, that leaves you with just 50. So if your bills for the month end up being 4,200, your daily run rate is 20, yeah, 40, $300. It's $10 a day, right? Because 4,200 divided, not deducted from the 45 would be 300. Take the 0 off the 300, divided by 3, and you're at $10 a day. $10 a day if your expenses are 4,200. That's why it's really important to look at the expenses that you have, all your bills. And the one thing you have to be careful for is to make sure that you're including seasonal expenses. Now, one thing you're going to notice is when I did this calculation, it was divided by 365 days to give you a daily run rate. But you actually have 5 extra days in there where you earned 150, because we used just the number of 30. That is done on purpose. It's really 30 point, I think, 33 or something like that. But it's done on purpose because there are expenses that people just do not calculate. So 5 days a year for those expenses that you're not even thinking about that you may have missed, like seasonal expenses or quarterly expenses that you may have actually left off your budget. Anyway, understanding your daily run rate is really important. Calculate your expense run rate, figure out what you spend on all your bills, whether it's, and then divide that by the 30, and you will see what your daily run rate on expenses are, and you can do the calculation that way. So if your daily run rate on your expenses is $110 and you know you only get $150 a day to spend, you're left with 40. And then maybe when you see that nifty new phone that you want to buy that's $1,000, but you have only $40 a day, you can calculate how many days it's going to take you to really pay for that phone. Or vice versa, if you're looking at an expense to add to your expenses, figure out how much that's going to cost you daily. How is it going to affect your daily expense run rate? So you have your cash flow run rate and then your expense run rate. And this is what happens is people think that they're earning such big salaries, but then they end up spending so much because they're not breaking it down into a daily run rate. Anyway, I hope this was helpful. And if you have any questions, feel free to hit me up. And I hope you like the easy formulas on going from figuring out your salary and also figuring out your daily and monthly income and expenses. Anyway, thanks for tuning in, and I will catch you on the next one.